Hi everyone and welcome to today's video. I'm Ragini Mukundan, a Microsoft Dynamics 365 ERP functional consultant at Cetas. This is part 4 of the series Understanding COGS Calculation in Microsoft Dynamics 365 Business Central. In this part, I'll be demonstrating what happens when you sell goods in Business Central and more importantly, how the system automatically calculates and posts COGS or cost of goods sold. We'll be seeing what happens when we create a sales order and post a shipment, post an invoice, how Business Central accounts for sales revenue and COGS, and the link between COGS and inventory. Let's start with the sales order. I have already created one in the system. We have mentioned the customer number, the item number, and the quantity we are going to sell. Based on these details, the system will automatically compute the total amount of the sales order. In this case, we are going to sell 10 units of the spokes. Just like with the purchases, creating the sales order has no financial impact. We are only documenting what we plan to sell. There are no GL entries, no change in the revenue, no change in inventory value so far. This is only a document. I'm going to try posting the sales shipment. The sales shipment is posted. Let's look at the posted sales shipment document. If you see here, the system has recorded that I have sold 10 units of spokes to this particular customer. Let's see the entries that are created in the backend on posting the sales shipment. With the posted sales shipment, item ledger entry and value entries have been created. Within the item ledger entries, we can see that the entry type is a sale. The quantity is negative, implying that there is an outward movement of stock. The stock has reduced by 10 quantities. The invoiced quantity column indicates how much of the shipment is actually invoiced to the customer. So far, since we have not invoiced anything, it remains at 0. We have the remaining quantity column. This column represents how much of the entire stock is still left in our location. Let's have a look at the value entries. Within the value entries, we can see the expected sales value of the inventory and the corresponding cost of the goods sold. We can also see the cost per unit of the item. The system works like this. First, record what moved. Then, record the cost of what moved. This dual table structure is why Business Central can calculate inventory value, COGS, and profitability perfectly and transparently. So, when we post the sales shipment, item ledger entries are created, value entries are created, GL entries are not created. Only the quantity is affected, not the financials. Let's go back to the sales order and try invoicing the shipped items. Now we come to the most important part. When I post the sales invoice, Business Central performs two sets of accounting entries, one for sales revenue and one for COGS. Let's look at the entries. In the first entry, our receivable account 2310 is debited by rupees 10,000 and our sales account 6210 is credited by rupees 10,000. This entry records that we sold goods and the customer now owes us money. Revenue is recognized immediately upon invoicing. In the second entry, our COGS account 7290 is debited by rupees 20. Then our inventory account 2130 is credited by rupees 20. This second entry is how Business Central calculates the cost of the item sold. It pulls the actual item cost from the item ledger and books it as COGS. COGS increases, which is an expense as per the PL, and your inventory decreases. So this cost leaves the balance sheet. This is the moment when inventory cost becomes an expense. In the sense, as per the matching accounting principle, revenue and related expenses are recognized together. The cost used for COGS always comes from the final inventory value created during the purchasing process. That is why the direct cost applied accounting entries that we had seen in part 3 were so important. They ensured that the correct cost reached the inventory account. Why these entries matter together? Sales revenue and COGS always work together. Revenue creates profit and COGS reduces that profit. The difference between them is the gross profit. So, revenue minus COGS is equal to gross profit. What happens after these two entries? After posting the sales invoice, the accounts receivable increases. Sales increases. COGS also increases. Inventory decreases. At this point, the financial statements are complete and accurate. Balance sheet reflects the remaining inventory and receivables. Income statement reflects revenue and COGS. Eventually, the gross profit is also correctly calculated. To summarize the sales cycle in Business Central, the sales order does not record any impact. The sales shipment records only the quantity related details. The sales invoice records two entries, that is, receivables debit to sales and COGS debit to inventory. This ensures that the revenue and the cost of those goods are recognized together, keeping both the PL and the balance sheet accurate and aligned. That brings us to the end of today's video. If you have any questions or would like us to cover specific scenarios, feel free to share them in the comments. Don't forget to subscribe to our channel for more practical Dynamics 365 insights and stay tuned for the next video in this series. Thank you for watching.